Hello again. I am excited about the opportunity for taking on assumable mortgages in today's market. And I want to tell you a little about the assumable mortgage and the terms, and also at the end of the video give you a real life example of the savings that you could have if you choose to do that when you buy a property. So the assumable feature on a mortgage has been in place on government loans, which means FHA, VA, and USDA loans since 1986. It only makes sense to assume a mortgage that was taken out after 2008, approximately, because today's rate is similar to the 2008 interest rate. In the years in between, you've seen the rates be at 5%, 4%, 3%, even some in the 2%. And those mortgages, if they're government loans, can be assumed by the buyer of the property. The first step is that the seller must start the initial assumption with their lender. The buyer must use the seller's lender to get approved, and the buyer would assume all the terms of the loan and the terms remaining. So the interest rate would be passed right along to the buyer. The mortgage insurance, if any, would be assumed and passed right along to the buyer, and the amount of the terms left on the loan, the years left on the loan, would be passed on to the buyer. So for an example, real life example, a listing at $365,000 has an FHA mortgage with a balance of $290,000, and the interest rate is 2.75% with 28 years remaining. Those are approximate, but that is a real life example. In this market, I'm going to use 6% just to give you an approximate 6% interest rate, financing $290,000 of the balance, apples to apples. The savings could be upwards of $150,000 in interest. That's quite a deal. And the other fact to keep in mind is if you assume an interest rate that's much lower, it helps the buyer, helps you afford a more expensive house. So something to consider. Talk to your agent. Call me if you have any questions. And for exact details, of course, always talk to a lender. Thanks for watching. Have a great day.